Good morning. This is Jeffrey Christian from CPM Group. Welcome to the 2018 CPM Gold Yearbook launch. This is our 32nd year of doing our reports as CPM Group. If you count the days that we did it at Goldman and J. Aaron, it's close to 50 years now. But welcome. Today's program, if I can figure out how to use the technology. Today's program excuse me. All right. Today's program will include a presentation from people from the CME group on the COMEX gold situation. We want to, as always, thank our sponsors and our partners. We have a number of sponsors this year. CME Group is obviously one. Commodities Now, Fidelitrade, Goldfields, the Institute of Scrap Recycling Industries, Kitco, Monex, NOAA Capital Markets, and the Sabin group of companies. And what we've always tried to do is have a diverse group of sponsors from every sector of the market so that we're not seen as necessarily beholden to either the supply or the demand side of the market. And we are glad to say that most of these clients have been sponsors of this program since its inception and since we started taking sponsors in 1996. In addition to that, we have 3 partners that we work with in China: the China Gold Association, China National Gold Corporation, and Jingyi Gold. They are our partners. They translate the reports and distribute them in Chinese in China. They have been our partners for approximately 5 years now, and late last year we signed an extension for this program and other programs in the partnership that take us out to 2024. So we will be partnered with them for the next 7 years on that, and we're very proud to have them here. The Yearbook program itself, this program is being recorded, and we will send out a link afterwards so you will be able to review it or forward it to others who might be interested in it. The program today, I will start with a few introductory comments, and I'll pass the microphone to Rohit Savant, our Research Director and Chief Precious Metals Analyst, who will talk about investment demand and supply. He'll pass the microphone to Yvonne Lee, one of our precious metals and base metals analysts, who will talk about fabrication demand and official transactions. She'll pass it back to me. CME, we have Albert Ning and Tom Hart from the CME group. They will speak about some of the record volumes that we're seeing in the gold options and futures contracts there, and some of the developments that are going on in the CME gold market. And then we'll open it up for questions. There is a question box that you should have on your dashboard, and you can type in questions, and I'll sort of run moderation over the questions. The gold price last year was a very interesting development. On an annual average basis, the price rose 0.4%. It was virtually flat. Producers complained that the price was not rising on an annual average basis, and fabricators were heartened by the fact that the price was relatively stable, because a lot of times volatile as well as rising gold prices affect jewelry demand and demand for gold jewelry. On a point-to-point basis, the gold price actually rose 14% last year. So from an investor's perspective, the gold price was up there with a lot of stocks and a lot of the other top-performing financial markets last year, rising 14% in a year in which the S&P rose approximately 22%. So what we saw in the gold price last year was something that really heartened investors, and it was part of an indication of what we're seeing, which I think Rohit will speak more about. Our view is that the gold price did, in fact, reach a cyclical trough in December of 2015, 2016, 2017 have seen the beginning of a recovery. Our expectation is that the price will continue to recover, perhaps at a more moderate pace this year. We're looking for relatively flat gold prices in the second and third quarters, but with prices then resuming their increase in the fourth quarter and into 2019. Longer term, we expect gold prices to rise to record levels at some point in the next 5 to 10 years. We don't see the trigger points for that kind of surge in investment demand in the immediate horizon, but given the state of the world, frankly, I think those changes could occur at any point in time. CPM Group sent out a market commentary yesterday, which many of you probably had seen. March, April of 2018 marks the 50th anniversary of what could be considered the free gold market. It was March 17th, March 18th of 1968 when the London Gold Pool was closed. That was a mechanism that the central banks of Western Europe and the United States and other countries had, where they tried to keep the free market gold price in line with the $35 an ounce official gold price that was set at Bretton Woods, New Hampshire, with the creation of the IMF and the post-war international currency regime in 1944. By March of 1968, the economic and political strains were such that they abandoned the attempt to manage the free gold market and keep it in line with the official price. And at the same time, the U.S. Treasury reduced its cover of currency in circulation to 25% gold cover. And Lyndon Johnson suspended what they called the private gold window, in which non-governmental agencies, individuals and corporations and banks could take dollars to the U.S. Treasury or a national bank and exchange it for gold. There had been a tremendous run on gold. 33 million ounces in the first quarter alone were withdrawn from the U.S. Treasury by investors turning in dollars. And that was on top of a couple 100 million ounces from 1960 to 1967. And the pressure and pain was just too great. So in March, April of 1968, the private sector window was closed, and really the free market gold price was open. So it's 50 years of the gold market being open. I'm kind of depressed because I realize I've been involved in the gold market for 40 of those 50. And if you count the times that we were involved with producing these reports with Jay Aaron and Goldman Sachs, these reports have been around almost since the beginning of the free gold market. One of the themes that we have in the Gold Yearbook, which Rohit will talk about more, is the concept that we've seen this year. Investors who buy gold out of fear, out of capital preservation, have backed away sharply from the gold market, but they've been replaced by investors who are buying gold based on capital appreciation expectations. So we've seen a shift, simplistically, from fear to greed. A lot of people who were buying gold because they expected another financial crisis, a major recession, if not a depression, hyperinflation, soaring interest rates, all sorts of economic, financial, and political problems. A lot of people have been buying gold for many years based on those fears that those things could reappear, have sort of backed away from the market. There's still some buying in that area, and I think it's kind of ironic because we think that the risks that the world is facing are probably greater now than they were even in 2007, 2008, just before the Great Recession and the global financial crisis. But for whatever reason, the collective wisdom of the market has been a diminution of gold investment demand based on fear. But that demand has been largely replaced by investors who are looking at gold at $1,260, $1,220, $1,280, and saying, I think I want to buy gold here because I think the price is going to rise. our economic projections are relatively flat. You do see that we have a recession, a relatively mild recession, put into our projections for the United States and the industrialized countries over the next couple of years, probably 2019. But then we have relatively flat growth. It's slower growth than we saw in the period 2000 to 2007, but it's in line with the growth that we saw from 1980 to 2000, which was at 3.3%, in line with what's considered a non-inflationary sustainable economic growth rate. That said, we do think, as I said earlier, that at some point over the next 10 years, there will probably be another economic spasm, a deeper recession than we're expecting in 2019, and perhaps a return to global financial crises on the order of what we saw in 2008, 2009. That's one of the major themes that we're seeing in the gold market. And on that happy note, I am going to pass the microphone now over to Rohit and let him take it from there. So bear with me for 1 second while I do that. And Rohit, you should be in control now.
Thank you, Jeff. So I'm going to start here by talking a little bit about investment demand. Last year, we had investment demand for gold at about 19 million ounces. This was down pretty sharply from the 26 million ounces of net gold investment demand that we saw in 2016. There was, even at 19 million ounces, that's a pretty substantial amount of investment demand for gold. That said, it did come off a little bit during the year, primarily because there was limited concern about inflation. You had a strong stock market going from strength to strength with limited volatility, and you had a generally healthy global economy. So there was some investors who pulled back from making purchases during the year. This year, we do think that net investment demand would rise from levels last year, not in a big way. We do think that net investment demand would probably be about 20 million ounces this year, just a little bit over 20 million ounces this year. You are seeing some renewed concerns about inflation. The stock market is still strong, but it's become a lot more volatile this year than it was in recent years. And there are some concerns about medium-term growth in the US. So in the short term, no one necessarily sees a recession, but in the medium term, there's potential for a recession in the next year and a half, 2 years. So all of that, we think, would help to support gold investment demand this year and also be supportive of prices. Interest rates have been rising, and part of that has to do with the Fed raising those interest rates, and part of it has to do with decline in demand, both from investors as well as the Fed, for treasuries at this point of time. So you've got this decline in demand for treasuries, and that is expected to coincide with an increase in the supply of these treasuries from the US Treasury to finance the growing deficit. So you have a combination of things working here which have been pushing interest rates higher. We expect, obviously, interest rates to continue to rise, and that is expected to be a mild headwind for gold prices, but we don't necessarily see interest rates being a major deterrent to higher gold prices in the short to medium term. There are multiple reasons why we think gold prices would continue to rise even with these expectations of higher interest rates. One is asset reallocation. So the increased volatility is one most definitely pushing some of the more risk-averse investors out of risky assets towards cash and asset diversifiers like gold. Gold is still a relative value compared to some of the other asset classes. So if you look at stocks, bonds, real estate, all of these markets were inflated substantially post the recession in the ultra loose monetary policy that we've had, whereas gold is still about 30% below its peak reached in 2011. So you still have relative value there compared to some of these other markets. With regards to the US dollar, we see limited upside from where it is right now. So a lot of the expectation of higher interest rates is already factored into the currency. You have these ballooning deficits in the US, and at the same time, you have other economies doing relatively better compared to what they were doing in the past few years. So you're likely to see some of the investments that have been pouring into the US shift out of the US into these other countries. And so all of these factors collectively, we think, limit the upside for gold. Limit the upside for the US dollar, which is positive for gold. And then you have real interest rates. So while nominal interest rates are rising, real interest rates are still negative. And we don't think that the Fed or any of the other major central banks are likely to raise interest rates more aggressively than levels of inflation. So we basically think that they'd stay behind the inflation curve. And so real interest rates would remain in check. And if you look on a historical basis, I'm sorry, I'm just having some trouble moving these slides. So if you look on a historical basis, so this chart basically shows you the median returns on gold in different interest rate environments. And this data goes back pretty much the last 50 years. And what you're seeing here is that gold prices have, on average, performed pretty well when interest rates are slightly negative to zero, real interest rates, which is about where we are right now, and which is where we are likely to stay in the short to medium term if the expectation that the Fed and other central banks remain behind the inflation curve. So all in all, we don't necessarily think that the increase in nominal interest rates are likely to be bad for gold in the short to medium term. Our expectation for inflation is for it to rise moderately. We don't expect sharply higher inflation or hyperinflation at any time in our forecast. We do expect inflation to rise in the short to medium term. You have a global economy which is growing collectively for the first time since the Great Recession. You've got ongoing strength in the jobs market. You've got relatively stronger oil prices this year. You've got late-stage fiscal stimulus in the US, limited upside for the US dollar for the reasons mentioned before, and you've got potential for trade wars. So all of these factors are inflationary, and we think that they would help to push inflation up from the depressed levels that they've been at in the past few years. That said, you also have some headwinds for inflation. So while the jobs market the headline numbers are good, and there's no doubt that the jobs market is healthy, there are some soft spots. So you have underemployment above average levels in the US. You have technology, which continues to weigh on wage inflation. The upside potential for oil prices from here is limited. With oil prices rising above these levels, you do tend to see increased supply in the US, which somewhat brings that price back down. And in terms of demand, you have healthy demand, but you've also got a lot of efforts being made to use oil in a more efficient way. So that somewhat limits the demand side of the equation as well. And in addition to all these factors, you have monetary policy normalization. So while we don't think that central banks will try to get ahead of the inflation curve necessarily. We do think that their normalization of monetary policy will prevent inflation from running out of hand. So any signs of inflation are going to be treated as good for gold, even if they're not necessarily hyperinflationary. So we do think that even though our expectation for inflation is moderate, and that is most likely how it would play out, the market is likely to respond more strongly towards any positive inflation than they probably should. So with that, we move on to some of the indicators of investment demand. What we're looking at here is the net and gross investment demand in exchange traded funds. And last year, the net purchases made by ETF investors came off from the levels we saw in 2016. So globally, investors bought about 5.3 million ounces of gold on a net basis in 2017, which was off from 16.5 million ounces in net purchases in 2016. Much of that softness and demand for ETFs occurred in the second half of last year. During the first half, there was a lot of aggressive buying in ETFs, but that softened to some extent in the second half of the year. And 2016, we did see a pretty substantial increase in net investment demand for ETFs, but that had followed 3 years of net declines. So even though we did see a jump up, it did not take the gross levels of ETF holdings above where they were in 2011. This year, the purchases have been somewhat slower compared to last year. As of the first 2 months of this year, investors have added about 300,000 ounces of gold to their holdings. We expect them to continue being net buyers, possibly increasing their purchases as the year progresses. Demand for coins declined pretty substantially in 2017. We did see global coin demand slip to levels that were seen last in 2012. That decline in demand was there were a variety of reasons for that decline. One was some of the investors that are interested in buying these coins were not doing as much of the buying in the gold market last year. Those are those investors who were buying out of fear, the longer term investors. A lot of the investors had in fact moved to the ETFs. So these investors, there were fewer of these investors doing the buying. And what was also seen was that a lot of the demand was being met by resale from existing investors. So that was actually reflected in the sharp decline that we saw in various premiums for these coins. Last year, the premiums for the coins were actually the lowest they've been at least since 2012. So a lot of the demand that was in the market for these coins was being met by previously sold coins. And this chart is showing you the production of coins by various mints, which was down pretty substantially last year. With the exception of the South African mint, where production actually rose, all other major mints saw a decline in the amount of production due to reduced demand. So in South Africa, you did have an increase in demand both domestically because of the political issues there, as well as you did have some increase in demand for Cougarans in Europe. I'm sorry, there seems to be a lag in moving the slides forward. So what you're looking at here is net investment demand or net long positions held by institutional investors on the COMEX. While these did decline last year relative to 2016, they were still pretty high, with the exception of a period during July when net investment demand, or rather net long positions, came off pretty sharply due to the buildup in short positions during that period. But if you look at the chart historically, the gross long positions were still and are still fairly high. They're comparable to the period between 2009 and 2011 when the gold market was going up strongly. There has been an increase in the number of short positions during the past year compared to the period between 2009 and 2011. But nonetheless, the net long positions have held up pretty well when you look at it historically, and this shows that there's generally a positive sentiment towards gold in the market, in the futures and options market. So Indian investment demand continued on a downtrend. It's been in a downtrend pretty much since 2006. Last year, investment demand in India came off because of healthy economic growth in the country, an extremely strong stock market, and as well as efforts by the government to get investors to reduce the amount of money they divert towards gold. So one of the products that they had introduced in 2015 is gaining traction and is helping to reduce the amount of physical gold being bought in India as an investment. That's the sovereign gold bond. It basically replaces or gives investors an option to invest in these bonds, which pay interest and are not actually backed by physical gold. So there has been an increase in demand for these products since 2015, which is in addition to the healthy economic growth as well as strong stock market weighing on Indian gold investment demand. This year as well, we expect Indian investment demand to remain flat to slightly lower compared to last year for most of the same reasons that we saw during 2017. Chinese investment demand, the story is a little bit different here. You have been seeing an increase in Chinese investment demand. While it's still lower than the levels that we saw back in 2013, Chinese investment demand has been on a rising trajectory. Part of the reason for that is the relatively fewer options, attractive options for Chinese investors to put their money in, which has diverted some of the investment money towards gold, and that's what's being reflected in this increase in gold investment demand over the past several years in China. So with that, I'd move on to the supply section. Total supply was still lower than the record high level of total supply that we saw in 2012. And part of the reason for that is that secondary supply or scrap recovery of gold has been flat over the past few years. That said, mine supply has actually been increasing and reached a new record high last year of 97 million ounces. We expect that mine supply will continue to rise this year to about 97.5 million ounces. The rate of growth in mine supply has slowed pretty substantially when you look at the period between 2008 and 2016 and compare that with 2017 and 2018. And part of the reason for that is the reduced amount of new projects that have come on stream in the past couple of years, as well as what's expected to come on stream this year. Also, the reduced amount of money that's being spent towards exploration and expansion in the past few years. So all of those factors are weighing to some extent on mine supply, and therefore we do expect mine supply to rise this year, but at a much slower pace than we'd seen between 2008 and 2016. So if you look at this chart, between 2011 and 2017, on average, there was about 2.5 million ounces of new capacity that was being brought on stream. And when you compare that with the period between 2018 and 2022, there's only about a million ounces, a little over a million ounces in new mine capacity that is being brought on stream on an annual average basis. So there's a substantial decline in the amount of new capacity that is expected to come on stream. And even in the past couple of years, you've seen a decline in the amount of new capacity that's been coming on stream because of the reduced spending, as well as the putting away of a lot of uneconomical projects. So if you look at this slide shows you that only the fittest projects were able to come on stream in the tough price environment that we've experienced in the past few years. You've seen only those projects with lower cash costs and higher grades being actually developed. The slide on the right-hand side shows you the grades, and the 2017 grade is not down. We've just excluded the Brucejack project from that. We just excluded the Brucejack project from that list, because if you include that, you actually get average grades of about 10.8 grams per ton for 2017. So we've excluded that, which explains that decline in 2017, but it's not actually a decline. What we have been seeing is an increase in all-in sustaining costs. So all-in sustaining costs bottomed out in the first quarter of 2016, and since then they have been rising. They have been rising on a combination of an increase in cash costs as well as sustaining costs. So sustaining costs were beaten down and driven down substantially when the price of gold declined, which also explains to some extent the reduction in the new projects as well as the expansion projects in the gold mining industry. That has started increasing as mining companies as well as investors have become a little bit more confident and comfortable with where the gold price is right now and where it's expected to head. They have been increasing spending on these sustaining capital expenditures, which has been driving up that cost. And then simultaneously, you have been seeing an increase in cash costs, which have a very close correlation with the price of gold. So the improvement in gold prices since 2016 has actually had an upward push on cash costs. So a combination of increased spending on sustaining expenditures plus cash costs has driven up the all-in sustaining costs, which are now, as of the third quarter of last year, at levels seen in the second quarter of 2015. As I mentioned in the previous slide, cash costs have moved up. So when you compare the average cash cost in the third quarter of 2017 was about $690, which when you compare to the third quarter of 2016, it was at $675. And for the same quarter in 2015, it was actually at $667. So it has been gradually rising over the past few years alongside the price of gold. And this is fairly typical given the positive correlation between the various input costs and the cost of the metal that's being extracted. This slide shows us exploration spending on all non-ferrous metals, and it breaks gold out separately. So again, here the spending on exploration bottomed out in 2016. investors as well as mining companies have become a lot more confident about the price of metals as well as gold. And so you can see that last year, when prices gave a clear indication that the bottom was behind them and showed signs of stability, there has been an increase in spending by mining companies. And that's reflected here in this chart, where spending in the gold sector is now back to levels that it was at in 2014. We expect this expenditure to continue rising at a gradual pace over the next several years, which will have a positive impact on mine supply, but not for at least another 8 to 9 years. So with that, I will pass this on to Ivan to speak about fabrication demand.
Thank you, Ro. Now let's take a look at fabrication demand. Gold fabrication demand is estimated to have totaled about 97 million ounces last year. This was up from about 94 million ounces in 2016. A couple of factors resulted in this year-on-year increase. The global economy was doing well last year, and this increased discretionary spending. Usually, the more money people have, the more likely that they're going to spend on gold-bearing items such as jewelry and personal electronics. And also, the US dollar was relatively weaker last year, and this reduced the price of gold in domestic currencies of consuming countries. So that also helped increase fabrication demand. Subsector-wise, the rebound we saw last year came largely from the jewelry sector. In China and in India, two of the largest consuming countries of gold in the world, there were strong recoveries in the jewelry sector. China's jewelry demand rose by a little over 10% year-on-year last year. And this was in contrast to a decline of nearly 10% in the previous year. The strong rebound in jewelry sales reflected the attraction of gold as an alternative to other asset classes in the Chinese market. Like Rohit mentioned earlier, Chinese investors are slightly different from investors in the West, because they don't have a lot of options to put their money to invest, apart from the local equities market and the property market. The Chinese yuan actually was pretty strong last year, and it should, in theory, have provided a strong backdrop for Chinese investors if they wanted to invest in overseas markets. But because Beijing exerts a strict control on where the Chinese yuan can flow, that made it almost impossible for Chinese investors, especially retail investors, to invest overseas. So basically, Chinese investors are very frustrated because they have more money now, but they don't have a lot of options in terms of investing. So they put money into gold jewelries as well as gold bars and coins when they see gold prices are not rising sharply. In India, too, demand had a very strong recovery last year, up by about 5% year on year. But the demand increase in India was mostly this pull-in demand amid uncertainty over the implementation of this new goods and services tax on gold. In July last year, the GST was introduced, and the GST on gold was raised to 3% from 1.2%. At the same time, the Indian government also made it mandatory for consumers to disclose their tax code or permanent account number for high-value gold purchases. These are likely to disrupt the business of small jewelers because they account for nearly 2/3 of India's total gold sales. And we think this is going to hurt gold jewelry demand going forward. So for this year, our projection is that gold fabrication demand is likely to remain flat from the levels we saw last year. A number of factors. One is the continued strength in gold prices this year. Gold prices on an annual average basis are likely to trade above the levels seen last year, although the pace of price gain is likely to slow down. But for jewelry demand is usually sensitive to price changes and price volatility. So taken together, we think this price trend is going to cap demand growth this year. And also, jewelry demand is tied to income growth. The global economy has been doing very well, but it has not translated into big improvements in wage growth. So slowing wage growth will be somewhat negative to jewelry demand growth this year and also in the coming years if there is no significant increase in wages. And also there is this ongoing shift in consumer spending pattern, especially among young people, where they prefer light carat gold jewelry, or they just prefer to buy fewer pieces of gold jewelry. And this ongoing trend is going to weigh on gold jewelry demand this year and also in the coming years. Central bank buying. Central banks as a group were net buyers of gold last year. They bought a total of 11 million ounces of gold last year, almost up by 48% from 7.4 million ounces during 2016. And this big increase in central bank buying last year came despite a lack of reported purchases by the Chinese central bank, the People's Bank of China. The PBOC was actually one of the largest net buyers of gold in 2016. Last year, a total of 16 central banks were net buyers of gold, although only three countries were the main buyers. They were Russia, Turkey, and Kazakhstan. I will talk a little bit more on the Turkish central bank later, but the three countries I mentioned just now, they bought their buying of gold accounted for about 95% of total central bank gold buying last year. This chart shows that central banks as a group have actually been buying gold over the last decade. Last year, the level of net gold buying by central banks rebounded to levels seen from 2010 to 2012 when their net purchases averaged around 11 million ounces. But the 2017 net buying level was still lower than the 15.7 million ounces average net purchases by central banks between 2013 and 2014. Central banks tend to be more price sensitive than private sector investors. The trend in these banks' net buying of gold over the past few years reflected this nature, with central banks buying more gold when the price is lower and less gold when price is higher. Over the coming years, we think it's likely that less price-sensitive private sector investors may squeeze out central bank buying because they will drive the price higher and faster, and central banks will be more reluctant to pay higher prices than private sector investors will. Still, we think central banks as a group will continue to be buyers of gold in the next decade. For this year, our projection is that central banks are going to remain net buyers, and they will probably buy approximately 10 million ounces of gold to their monetary reserves. The Chinese central bank, the PBOC, may resume adding gold to its monetary reserve sometime this year. China underwent a leadership transition in March this year, and now the Chinese government has even more control over its economy. This includes the levels of its total monetary reserves. So it means it will have more tools and resources to manage where the economy is heading and where it wants capital flows to go. Our thinking is that it's likely sometime over the course of this year, the PBOC will consider market conditions ripe enough to resume gold purchases. For central banks, the primary goal to buy gold is to diversify their monetary reserves. In doing so, they add gold as well as non-US dollar forex reserves. A little bit more on the Turkish central bank. The Turkish central bank started buying gold for the first time since 1991 last year. The Turkish central bank didn't really say why they decided to start buying gold last year, but our thinking is that they are trying to diversify their reserve assets because of the deterioration in relations between Turkey and the West. Between May last year and the end of last year, the Turkish central bank is estimated to have purchased 2.8 million ounces of gold. It's likely that they will continue to buy gold until it feels it has accumulated sufficient gold to contain any economic downturn caused by international politics. BIS. The BIS transactions are quite distinct from the monetary reserve management of central banks and monetary authorities, and are excluded from the net additions and reductions to gold held by central banks. It's because many of these additions and reductions are not really policy-based transactions. They are also not additions or reductions in the core BIS gold holdings. The chart on the left showed that since April 2016, the BIS started aggressively building gold swaps once more after unwinding them from 2014 to the first quarter of 2016. This was to provide dollar liquidity to its counterpart banks and taking gold as collateral. By the end of 2016, the BIS had added about a little over 15 million ounces of gold to its holdings. This was more gold than was added back in 2009 and 2010. The European banking system was actually on better footing in 2016 than it was in 2009 and 2010, but there were still signs of strains, especially in the Italian banking system. The primary purpose of these swaps is to provide liquidity to banks. For this reason, these banks swap their gold for dollars. The swaps should be seen as efforts by commercial banks to build up dollar and currency reserves in the face of liquidity stringencies. As the European economy continued to recover over the course of last year, the BIS unwound some of the swaps. By the end of last year, it had unwound about 1 million ounces of gold from its holdings. The BIS is not actively seeking to hold more gold, but rather is taking the gold in exchange for the dollars and other currencies it is lending to the banks. Lastly, very briefly on gold stock demand. Investment demand about a little over 20 million ounces this year, and also central bank demand about 10 million ounces this year. Back to you, Jeff.
Thank you. Let me just recapture control of the screen, if I can. Okay. Hopefully you're seeing my screen again. Thank you, Rohit, and thank you, Yvonne. Very interesting points that you've been making about a variety of issues here. We're going to turn the microphone over now to Tom Hart and Albert Ning at CME. They are a sponsor and have been a sponsor of CPM Group's work for years, as well as a very good client. I'm going to be ostensibly, I guess, in control of the screen, so it'll be a little bit difficult here, but they will tell me when they want me to advance slides. Albert and Tom, are you on and are you in charge?
I'm here, Jeff. Thanks very much. And thank you certainly to CPM Group for having us on the call today. This first slide, in some ways, our GC contract acts as a proxy for interest in the gold market as a whole. We saw record GC volumes in 2017, and that trend has only accelerated as we head further into 2018. While interest from our client base is steadily increasing in the overall commodities complex, growth has been particularly strong in metals. We believe the overall market environment is ripe for this trend to continue in the future. As you can see, quarterly volume in COMEX GC contract has never been higher, surpassing 20 million contracts in Q4 of 2017 for the first time. With this chart leaving out the last 5 trading days of the month of March, we've already surpassed that quarterly record in 2018. Following a bottoming of the gold price in Q4 of 2015, we have seen steady increases in the volume in our GC product. And interestingly enough, this bottom has also coincided with the first rate hike in this current cycle from the Fed. Jeff, if you can move the slide to the next one. Thank you. On the next slide, I'd like to point out some changes in the geographical makeup of our client base. In the past, the majority of our volumes had originated from clients here in the United States. However, we are seeing a trend towards increased global participation in our metals futures contracts. In January 2018, we noted that close to half of our GC volumes have originated from clients outside of North America. This growth has been driven by increases out of the Asia Pacific region mostly, and the overall APAC volumes in our GC contract are up 238% since 2012. We certainly believe that this global growth further reinforces the COMEX gold future as a worldwide benchmark for the precious metals industry. I'm going to pass it along to Albert very quickly to talk about some things we are seeing in the gold option market. Again, thank you to CPM Group for having us on the call, and thank you for everyone online for listening.
Thanks. Could we just go to the next slide? So I thought it'd be interesting today just to highlight one of the products that has grown in popularity. I believe everyone on the call is probably familiar with our normal gold options, but we've seen quite a bit of pickup in the weekly Friday options in the last, I would say, 12 months. Just the bottom left-hand chart would show you that sometime in 2017 and late 2016, when we were only doing 200 contracts a day, but now into 2018, that number has grown into about 2,000 contracts a day, and we're just finding that this product is meeting a customer demand that is out there. Specifically, we find that Friday options help customers time global macro events better. Namely, it fits the employment situation number, it fits retail sales, and it helps customers time FOMC numbers. So I thought it'd be interesting today, one, to look at what a snapshot of the liquidity looks like. And what I've taken in the bottom right-hand corner is a snapshot of what gold weekly options would have looked like on March the 9th. So just going to that middle section there, you can see that gold was trading about 13.15. If you yourself wanted to purchase a call option for only 7 days, as opposed to roughly 30 days, which is our monthly contract, that call option would have cost you $3.30, bid at $3.70 offer, which is to say that roughly $3.50 was a fair price for a $10 away from the money call option, meaning it would cost you roughly $350 to have 1 week of exposure to 100 ounces of gold. To the downside, if you had wanted to do something similar, you could have bought the 1305 put for roughly $2.80, meaning $280 would have gotten you exposure to the downside of gold for about $280. And this is to say that this product has been quite successful in the last few months, and we think that this trend will only gain popularity. And one thing I did want to mention is that as these products do start to take hold, we're always looking for feedback from customers, meaning if there is a need out there in the market for a Wednesday option or a Monday option, we're always very happy to hear about it. So with that, I really wanted to leave the call today just mentioning that if there is customer feedback, specifically from myself and Tom, you can reach either of us at our Metals email address, so metals@cmegroup.com. And with that, I think I just want to thank CPM Group and hand it back to you.
Thank you, Albert. Thank you, Tom. It's our honor to have the CME here on this event. There's your disclaimer. At this point, we're going to open it up for questions on the whole thing. I will point out that we do have, in addition to the Gold Yearbook, a Silver Yearbook, which we will launch in April 24th, and excuse the ambient noises, and also a Platinum Yearbook, which we will launch in late June. The April will be interesting because we will be launching the Chinese edition on the 26th of April in China. So Yvonne and I will be doing our portions of the webinar on the 24th from Shanghai. Our partner on the Silver Yearbook is the Huatong Silver Exchange, as well as the CME Group. And so we will be probably broadcasting from the HSE's offices in Pudong at that point. At this point, I'm going to open it up for questions. I believe that the only way to ask questions is to type them in. I have one question here already, and I'm going to have to scroll it through because it's not behaving the way I would like it to be. But it says for real interest rates, you're using 1 year T-bills minus CPI, the real rate inferred from the 10-year tips. Both of these appear popular measures in real rates or to something else. We tend to use the T-bills minus CPI. We're just more comfortable with that. I don't necessarily know if the correlation between that measure of real rates and tips is high or low. We've just always tended to not use tips. Other questions? Okay. So if there are no other questions, we will thank you all for being here today, and we'll look forward to talking to you in a month's time about silver. And as I said, Yvonne and I will be speaking to you from Shanghai at that point. Thank you and good day.